This week, we're dissecting a deep dive investment thesis on Mohawk Industries, ticker MHK.
Yeah, the core argument is that it's a classic cyclical value play, one that's really poised for a big breakout in 2026.
And that breakout is pinned on macro tailwinds and some pretty significant internal cost cutting.
It's a compelling story for sure. The $166 intrinsic value target, that definitely gets your attention. But, if we're going to trust a bullish valuation like that,
we have to trust the foundation.
Exactly. We need to know the analysis has rigorously defined its own breaking point.
So let's start right there with what feels like the structurally thinnest part of the analysis, the risk section.
Right. The primary risk section needs substantial expansion. It needs more quantitative tie-ins to really stress test the investment thesis.
As it is, the two main risks listed, housing market lag and a drop in consumer spending, they're too concise.
They're labels, not analysis. And that imbalance, it kind of undermines the robustness of the whole calculation.
You're right. A deep value analysis, especially one built on a cyclical recovery, has to account for those big macro headwinds with, proportional, measurable consideration.
We need to move past just listing the known risks. We have to define the exact analytical tripwires.
I agree. Just listing them leaves the reader without a tool to monitor the thesis. The big unanswered question is, what is the specific data point that actually invalidates this whole thing?
So the suggestion here is to integrate specific quantitative metrics. Thresholds, really. Things that would explicitly invalidate the core thesis or, at the very least, force a reevaluation of the timing.
Don't just mention the headwinds. Model them.
Model them and establish failure points. It's a powerful distinction because it forces the writer to engage with the downside beyond just, the obvious.
Okay, but how do we do that? How do you define those triggers without making the model unnecessarily complicated?
We can start with the most obvious constraint, the cost of money. Instead of just noting housing market lag, the analysis needs to quantify the critical interest rate threshold.
Because that's what slows down residential turnover and renovation financing?
It's the key. So, we establish a line in the sand, a critical metric that ties directly back to the existing numbers.
What would that look like?
I think we should specify something like, if 30-year fixed mortgage rates average above, say, 7.0% through Q 2026, then the projected 14.6% EPS growth is probably delayed until 2027.
Okay, so that 7% figure becomes a measurable trigger point. It validates the whole framework by defining its time limits.
And it allows the person reading the report to track the single most important external factor.
And we should apply that same quantitative discipline to the demand side, right? The consumer spending risk is just too vague without a defined impact on the valuation.
Precisely. For that risk, you need to define what level of decline in big-ticket items would actually impact the EPS recovery.
So a concrete example could be,
you could specify that a 10% year-over-year drop in overall renovation spending would hit the expected EPS, potentially pushing the valuation closer to that bear case target of $119.
That demonstrates the analysis has been fully stress-tested against defined consumer behaviors. It adds a whole other layer of integrity.
It does. But defining those downside limits brings us to the second major question, which is about the upside.
Right. If the macro story is so clear, what guarantees that MKH is the best horse to ride this cyclical upturn?
That's a critical pivot. We have to assume the reader is sophisticated enough to immediately ask, why MKH over a competitor?
To really solidify its classic value play status, the analysis needs to articulate MKH's distinct competitive edge. It can't just be a generic beneficiary of macro tailwinds.
And right now, the analysis makes a strong case for MKH's internal valuation metrics. The price to book of 0.86, the forward PE of 11.3, it screams cheap.
But that's where the weakness is, isn't it?
It is. The report highlights these great metrics, but it doesn't clearly establish why MKH is the most undervalued company to capture that demand compared to its direct peers.
The low price to book is compelling, but it lacks that explicit comparative context.
And low PB could just signal poor prospects, not inherent value. We need proof that they are the superior investment vehicle for this specific upturn.
So the suggestion then is to introduce specific relative valuation metrics, maybe some qualitative advantages too.
Absolutely. You have to justify the selection. If we don't present that comparison, the reader might just suspect that other building materials companies offer a similar, or who knows, maybe even a better value proposition.
So what's the most effective way to integrate that, quickly and visually?
I think a concise side-by-side comparison table. Show the forward PE and price to book for MHK against at least one key competitor.
That visual immediately strengthens the cheapness argument by putting it in context.
It moves the argument from MHK is cheap to MHK is the cheapest relative to its structural positioning. Much stronger.
And beyond just the raw numbers, the report did mention something, a strategic factor. The shift toward higher margin products like LVT and laminate.
Yes, that's the qualitative competitive edge the analysis needs to lean into, hard.
So detailing how that specific product mix gives MHK a measurable structural advantage.
Or a better margin profile compared to competitors who might be more reliant on, lower margin carpet.
Why is that LVT laminate shift so crucial for a cyclical recovery story?
Because it speaks directly to the quality of the recovery, not just the quantity.
Ah, okay.
LVT and laminate are faster-growing segments. They offer easier, more durable installation, so they generally command higher gross margins.
So if MHK recovers, they won't just recover sales.
They'll recover higher quality sales, which means faster margin expansion than competitors who are still stuck on legacy products. That difference justifies the entire focus on MHK.
That clarifies the competitive positioning immensely. Okay, let's transition to the third critical component, the internal controllable catalysts.
Right, the report highlights a huge number here. A $142 million cost-cutting target that Mohawk has already implemented.
It's a massive, controllable figure.
It is, but we need to make sure the analysis connects that leverage directly to the 166 target price. My concern here is that the report presents this huge cost-cutting machine as a major catalyst, but it fails to explicitly link it into the valuation calculation.
That's where some skepticism can creep in, right? There's always a risk that cutting $142 million, that's huge, could impair their operational capacity when demand finally ramps up.
That challenge is precisely why we need the linkage. The analysis needs to show confidence in the sustainability of those cuts. The weakness right now is that lack of integration. The $142 million in savings is just sort of presented as this exciting, separate fact.
And that leaves the reader unclear. How much of the projected 2026 EPS jump is from these internal efficiencies versus how much relies purely on that unpredictable external recovery?
Exactly. And that weakens the perceived reliability of the $166 target. It feels like too much of the forecast is relying on, macro fate.
So if the argument is that this is a value play based on a predictable recovery,
then the internal, controllable factors should have a defined role in isolating the floor value. So the suggestion is this. Model the immediate earnings accretion from that $142 million in savings.
And demonstrate its specific contribution to the 10.28 EPS forecast.
Thereby isolating and quantifying the internally controlled component of the recovery.
That's brilliant. If the reader can see a clear, tangible floor to the earnings, it significantly increases confidence in the whole thing. A defined portion of the recovery isn't dependent on macro movements. It's baked in.
It's baked in by management's actions. The analysis has to calculate the estimated per-share impact these savings are expected to generate. It demonstrates the material foundation of the forecast.
And it addresses that skepticism about the quality of the cuts. If they're sustainable and management's committed, the financial impact is immediate.
It is.
So how do we recommend integrating that specific financial link into the narrative without turning it into a math lecture?
You stated clearly and concisely, maybe in a summary box right near the valuation model. For instance, of the projected $1.31 year-over-year EPS increase, approximately, say, X% or Y dollars per share is conservatively attributable solely to the completed restructuring and that $142 million in savings,
providing a strong floor for the 2026 forecast, regardless of the pace of housing recovery.
Right. That transparency transforms the thesis.
It gives the reader a concrete, internally driven figure that supports confidence in the 166 valuation and justifies the focus on management's execution.
And it ensures the reader understands the value opportunity is driven by two distinct synergistic forces, the external market thaw and the internal self-help measures that management has already completed.
Okay,